So welcome to this video series where we're going to be talking to you a little bit about property investing, and this is the property basics section. So we're going to kick off first and foremost about money in the bank versus money in property. So why is money in the bank not as good as money in property? Well, very simply, there's a few reasons. So first of all, money in the bank. What is the bank currently giving you for your money in the bank? Are they giving you a lot? Are they giving you a really high interest in return? Or are they giving you a very significantly small amount of return or interest on your money? Well, for those of you with money in the bank, particularly in the UK or throughout most of Europe, you'll notice that either you're getting paid a very small interest, or for some places you're actually having to pay to keep your money in the bank. Therefore, money in the bank is not necessarily a great thing. And when you compare that to the consumer price index that the government currently gives us, which is give or take around the 2.5% to 3% every single year at the minute, what that then tells you is that your money is currently devaluing. Let me explain how that works. So the interest in your bank that you're currently receiving is money going into your pocket. Okay, so that is increasing the value of that money by set amount. So 0.1%, 0.2%, whatever it is they're giving you. The consumer price index, however, is how the government judges the devaluation or depreciation of the pound. Now, my personal belief is that it's significantly higher through something which we all call inflation, which is where you look at things like house prices, you look at things like necessary consumables, so bread, milk, eggs, cheese, etc. The real rate of inflation is give or take somewhere between 6 and 10% a year as an average. However, if we look on the government guidelines, just to stop any contention, the government is currently saying it is somewhere in the region of 2.3 to 2.5%, even as high as 3% on certain years as the consumer price index. Now, that is a devaluation of the value of your money. So your money is losing a minimum of 2.3% a year, even anything up to maybe 3% a year, based on those figures and using that understanding. So you're gaining 0.1%, however, you are losing 2.5%. Therefore, you are overall losing a lot of money or a lot of value in the bank. Now, technically, you would be better off drawing that money out of your bank and setting fire to it and taking the warmth from that money, because you are getting a lot more than what you're getting from the bank. Now, I'm not saying you need to go and do that. Do not burn the money. It is illegal. It's not a good thing to do. However, just understand that money in the bank is not necessarily a good thing, and savings is basically a way in which you can erode your money. So this is called financial erosion. However, if you take a look at money and property, you can see that the value of property increases over time. So historically, if you take a look all the way back to when records began for the property market, so back in the 1950s, you'll see as an average, every 8 to 10 years, the property market doubles in value. Now, that doesn't mean hard and fast every 8 years or every 10 years the property market's going to double, because like many things, it is cyclical. So you have cycles, so the value goes up and goes down and goes up and goes down and up and goes down. Now, if you actually follow the trend in certain years, so if you look between 1988 and 1998, okay, the value of property was roughly the same between those periods. So you actually had a slump in values. But if you look between 1998 and 2008, the property prices actually trebled in value. So as an average over those 20 years, you can see that the property prices doubled. If you have any doubts or any feeling that I might not be 100% correct, take a look at what your parents or someone you know who bought a house for say 30, 40 years ago, what they bought the house for, and roughly how much that house is worth now. What you'll very quickly realize is as an average, property prices double in value every 8 to 10 years. Now, we do not bank on this as part of our investment strategy, which we'll cover later. However, it is something very useful to understand because you get a much greater return. Now, if a property doubles in value every 8 to 10 years, that's a 100% increase in a 10-year period, which means pretty much around a 10% increase. So 100% divided by 10 years, you'd be increasing somewhere around 8% technically, but you say 10% a year, roughly, which is significantly better than the 0.1% you're currently getting from the bank, and therefore is a way in which you can negate the loss in value through time and your financial erosion.